Europe is often described as financially stable, regulated, and resilient. Strong institutions, careful policies, a shared currency designed to prevent chaos. And yet, something inside Europe's financial system is quietly coming apart. There is no dramatic collapse, no sudden market panic, no single villain. Instead, the cracks are spreading slowly, hidden beneath complexity, bureaucracy, and the illusion of control. To understand why this matters, we have to go back to how Europe's modern financial system was built. After the devastation of the 20th century, Europe made a radical choice. Economic integration would replace competition. Shared rules would replace fragmentation. Stability would be engineered through cooperation. The creation of the European Union and later the Euro was not just economic, it was political. A common currency was meant to eliminate currency crises, boost trade, and lock peace into the system. At first it worked. Capital flowed freely. Borrowing costs fell across southern Europe. Banks expanded rapidly. The rise phase looked like a success story. Countries with very different economies were suddenly borrowing at nearly the same interest rates. Markets assumed unity meant safety. But the system had a hidden flaw. Monetary policy was centralized, but fiscal responsibility was not. This imbalance didn't matter when growth was strong. It mattered a lot when it wasn't. The breaking point arrived quietly, then all at once. When the global financial crisis hit, Europe discovered that a shared currency without shared fiscal discipline creates fragile dependencies. Banks held massive amounts of sovereign debt. Governments depended on banks to absorb that debt. The two became locked together. A banking problem became a government problem. A government problem became a banking problem. This feedback loop never fully disappeared. Instead, it was patched. Emergency lending facilities were created. Austerity measures were imposed. The European Central Bank stepped in as the ultimate backstop. These actions prevented collapse. They did not repair the structure. The fallout changed Europe's financial behavior permanently. Growth slowed. Productivity lagged. Debt levels stayed high. Negative interest rates became normal. Cheap money stopped being a temporary measure and became policy. Banks survived, but profitability weakened. Pension systems struggled under low yields. Savers were quietly penalized. Once again, stability masked fragility. Then came new pressures. Energy shocks. Geopolitical fragmentation. Aging populations. Each shock revealed the same weakness. Europe's financial system is excellent at delaying consequences, but poor at resolving them. Failed fixes followed a familiar pattern. More regulation layered on top of fragile banks. More liquidity added to a system already flooded with it. More coordination promised but rarely delivered. Structural reforms stalled because they required political sacrifice. Debt mutualization faced resistance. Fiscal integration remained incomplete. National interests clashed with collective needs. The system moved forward, but never healed. Modern data reflects this slow strain. Southern Europe remains heavily indebted. Northern Europe carries implicit guarantees. Banks hold sovereign bonds not because they're safe, but because regulation encourages it. The pattern repeats. Private risk becomes public responsibility. Public debt becomes monetary policy. Monetary policy becomes permanent intervention. This isn't unique to Europe, but Europe's design makes it harder to escape. The euro removes currency adjustment. Fiscal rules limit spending flexibility. Political fragmentation slows decision-making. The result is a system that absorbs shocks but accumulates stress. Like a building reinforced after every earthquake but never redesigned. History shows where this leads. Long periods of low growth. Rising political tension. Increased reliance on central banks to solve non-monetary problems. Europe is not collapsing, it is drifting. And drift is dangerous because it feels stable until it isn't. 3 lessons stand out. First, financial stability without structural alignment creates hidden fragility. Shared money requires shared responsibility. Second, delaying consequences increases their cost. Every temporary fix reduces future flexibility. Third, slow crises reshape societies more deeply than sudden ones. They erode trust, confidence, and cohesion over time. The open question isn't whether Europe's system can survive. It's whether it can evolve before pressure forces change. Because financial systems don't fail when they're weak. They fail when they're exhausted. If you want to understand how global systems break, not loudly but quietly, subscribe to the channel. Because the most important financial crises don't announce themselves. They unfold in slow motion while everyone assumes stability means safety.